just keeps going to someone listening to this for the first time. The primary thing that you're saying is that you think the returns on these products aren't quite what they're advertised or presented to be.
So that's the next layer. The deeper level to this is that these aren't dividends in a traditional sense. The returns of the fund are consistently great, but that's not what you get. These illustrations and the numbers on the page are based on the accuracy of long-term assumptions. Those assumptions aren't shared.
So it's just very, and
it's, as I said, and as some insurance companies will say themselves, it's a black box. And so let's say for a second, you do believe that an investment grade life insurance policy is for you. You have all this extra money. You do want to buy it inside a corp. You see all the tax advantages of doing it. Your accountant agrees and your peers agree that there's a lot of tax advantages to doing it. I think it's important to highlight historically why these haven't performed well, and say you can accomplish this with this universal life product and have some sort of at least predictability where I can buy the investment and buy into a US blue chip index or a balanced fund.
Because on the universal life product, I can pick and choose where I want to deploy a portion of my annual contributions.
Yeah, it's like you go to the bank and you get a list of fund options.
Whereas the participating policy, it just kind of goes into this investment pool.
And what you're not told, to this day, you're still not really told how dependent your dividends are in the interest rate environment. So I'll give you a quick example. I'm dealing with a client's policy, bought it in 2002. 20 years later, his dividend was supposed to be this year $10,000, $11,000. Based on the illustration, it's actually around $2,500. Significantly lower. So the question is why? This is not exactly the case, but this is the explanation I got, and it's along these lines. Back in 2002, interest rates were around 4%. The insurance company basically says, we're going to give you a guaranteed cash value, no matter what. It's going to go up every year for the rest of your life. It's never going to be more than the death benefit. So in this case, death benefit's $500,000, meaning at the age 100, the cash value is $500,000. In order for us to be able to finance that death benefit, we need interest rates to stay at 4%. If interest rates go below 4%, then that's our loss, but we contractually gave it to you. In order for dividends to stay at the level that were illustrated, we needed interest rates to go up to 8%, because that's what we've kind of predicted. Interest rates went to 5. Difference between 8 and 4, 5, 75%. You're now getting 25% of what was promised. So I find it interesting that you hear from insurance companies and advisors, well, the longer you have a policy, the more the investment component matters. But if the investment component is performing extremely well, but interest rates are a fraction of what was promised, then I guess what matters more is the interest rate environment and less is the actual returns of the underlying fund. Now, I would hope, given what's happened in the past, insurance companies, they know this. They're the ones that paid out settlements due to the vanishing premium litigation I covered in my book. I would only hope that they are significantly more conservative now. And maybe this is the best time in the last 10, 20 years to buy these products, and probably because maybe some of these companies were expecting interest rates to stay low for a long time. And the fact that they've effectively doubled over the course of the last year means dividends are going to be great. And to be honest, if you're buying this policy today or have it today, like you're going to get dividends for the next 20 or 30 years. Like my clients who aren't getting dividends, the issue isn't that they're not getting dividends now. They were getting them for the better part of 40 years. The issue is that when they're not getting them, I'm not being told why, and I'm not being told what needs to happen economically for dividends to return. And I just don't think it's fair to reinforce that. I think you should buy into things where you have proper disclosure and proper transparency, and you can see and choose where your money is going. And if you're going to buy into this product, I think it's very important that you know how dependent it is on the interest rate environment. And I think it behooves the insurance companies to kind of share a little bit what those predictions or what those assumptions are, just so you can make your own informed decision.